There's some people that get into tax liens, which tax liens you go buy someone that's past due on their property taxes. And, they eventually have to pay that or lose the property. They lose the property, you get the property. They pay it, you're collecting by paying up front on what that property tax is. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. You got cash, don't know what to do with it. Question came in on Ask the Money Nerds with just this situation. So let's talk about the possibilities. Now, Stolba, look, there isn't like a magic product out there. If there were, we'd all just own it and be like, cool, super easy. Mm-hmm. That's why investor DNA and understanding the individual is key. Looking at a myriad of options so that you might see what makes the most sense. And disclaimer, I'm not a registered investment advisor. I did pass my Series 65 back in the day. I did pass my 6 and 63. I did get those licenses, and in 2005 decided it was time to write books and speak and do these things, and I didn't like the system of how I was compensated on those things, so I walked away from it. But I can definitely give a big picture view of what options are out there, what types of things could be done.
Mm-hmm. That's great. It seems like a great problem to have some extra cash on hand.
Yep.
So let's talk about what to do with that money. Jim wrote in and said he just inherited about $250,000. He has no current debt at the time, just a lot of cash.
Nice to be out of debt.
Absolutely.
Hope for that at age 70.
Yeah. Peace of mind, a lot of freedom that probably comes with that. He's 70 years of age. He's not really interested in another business. He also does trade the futures on a daily basis, just not with a good return on investment. So he's wondering what to do with his cash. A little bit of a hobby more than a expertise, it sounds like, on the trading. Yeah, possibly.
Okay. Well, let's look at the different options. There's no debt, so nothing to worry about there. At age 70, there's a couple options to consider that can create cash flow. Now, this isn't going to be substantial cash flow, but it could be consistent cash flow and very safe. Had a college roommate, helped him out when I met with his parents because they financed a down payment for him and his brother. And it was we doubled what they were getting on their CD, but we cut their cost by a third because getting a second mortgage as for a down payment avoids private mortgage insurance, but it's a higher interest rate than a first mortgage. So it was a really winning scenario because they went from earning 2.5 to 5. And these guys, rather than paying, 7.5%, 8%, they're only paying 5%. So they just cut the bank out as a middleman. Mm-hmm. They had the collateral of the property. So does he have anyone that's buying a home that's in his family that's fiscally responsible, could potentially buy that home and cash flow it, become the bank.
Trust to pay him back.
That's complete collateral, right? Mm-hmm. Like that would be one example of what could be done here. It's not just your ordinary everyday example. A lot of people might think about there's dividend paying stocks in the stock market, but a lot of those dividends aren't really high dividends. Utilities typically pay dividends, right? Mm-hmm. But those aren't really high cash flowing types of scenarios. There's also things called immediate annuities. An immediate annuity means you put your money in and 30 days later, you can annuitize it to start kicking off monthly cash flow. Now, there's different types. There's variable annuities, which are actually just more expensive than most mutual funds. So I'm not a huge fan of them. The nice thing of annuitizing is you might be able to stabilize your cash flow, but limit what the growth is. But a lot of the times that's more of a indexed annuity that might do that, or a fixed annuity. The problem with fixed annuities right now is interest rates have been low for so long. These things are paying minuscule interest rates, right? Mm-hmm. But if you're willing to annuitize, there are kind of income-based immediate annuities that might give you, 6%. It's not the interest, it's how much interest and principal comes out from the $250,000 every year for the rest of Jim's life. So that's the most passive, don't think about it, a lot of safety. I don't love a lot of annuities because they just, you're locking your money into that payout once you do it. But at least you're not risking that you're going to run out. You're never going to outlive that. It's going to pay for the rest of your life. So that would be kind of an advantage there. Another thing that people consider, I mentioned on another video, called a bond ladder. A bond ladder is, the way bonds work is if we have interest rates, a bond is a debt instrument. So I could be lending money to the government. I could be lending money to a corporation.
Mm-hmm. I've heard about it at like school districts, right?
Yep.
Doing bonds.
Municipal bonds, even for like specific city projects, or, there's bond raising for certain communities. So yeah, you're lending money and they owe you that money at a specific interest rate. Now, if interest rates go up or down, it changes the value of your bond, right? So imagine if you go get a bond for 4% and interest rates go up to 5%. Well, if you want to sell your bond to get your money out of it, you're going to have to sell it for less because anyone else can go get a new one at 5%. So you have to sell it where it's yielding at least 5%, which means you actually hurt some of your principal, right? So volatility. Now, if interest rates go down, your bond value goes up because now people have to go, if they're investing new money in a new bond, it's paying a lower interest rate than what you've locked in. So you can sell it at a premium because someone's like, well, I could still get a better deal by paying more for your bond because it's older and it has a higher interest rate. Does that make sense?
Yeah, it does.
So it's an inverse relationship. But as bonds fluctuate, that could risk your capital, right? You could lose some of the principal. So a bond ladder might take a 1-year bond and a 3-year bond, because 3-year bonds are going to give you a little bit higher interest rate because you locked it up longer, maybe a 5-year and some 7 years. So you might have multiple bonds here. So if you decide to cash out or have them mature, you're not risking your principal, because now in 3 years you can get your full amount of money back and you just paid your interest during that time.
Got it.
But then some of your money is a little bit longer. So that's why it's a ladder, right? You kind of see the ladder phase here. They just have different maturities.
Okay.
Maturities when you can just get all your principal back. Okay. So you lent money to a corporation or to a government. It's really stable. Once again, interest rates have been really low. So as a business owner, that's awesome because you can borrow money really cheaply. As a retiree, not so awesome because you're not getting a high rate of return. Now, what you have to be really careful of is we know what investing is, right? We put money away and we hope that money grows over time. There's another thing to be aware of called disinvesting. So disinvesting is when we start taking our money out. But if we're taking our money out when the market's volatile, we might be taking it out during a time where the market goes down and it starts to chop away at our principal too much. And then it disinvests and actually goes to zero. So there's a lot of studies saying if you take more than 4% out in the stock market, you're probably going to run out of money because there'll be a year it's down or 2 years it's down. And if you take the same amount of money, it starts to destroy or kind of take from that principal.
Does disinvesting apply when someone's wanting to cash out of their 401k?
If you're cashing out, you just not really. It's when you're taking systematic payments for income supplementation.
Got it. Okay.
Cashing out, you get whatever it's worth at that time. It's when you're spending it over time.
Got it.
Okay. So we've got invest, disinvest. We've got bond ladders. We've talked about immediate annuities. We've talked about financing something for someone that you know, whether it's a family member that you feel is fiscally responsible, so that maybe they have to go to the bank and they're going to pay 5%. What if they paid you 5%?
Yeah.
You've got a piece of collateral behind it, which is the property. You could always refinance that, and that kind of stuff to pay them off.
Put in place with like if you're loaning money to family, like what kind of agreement?
Contracts. A capital lease is the document that we would use.
Okay.
In something like that, because you want it to be in the position of the bank, and you're in a first position on the trust deed. Yeah. So they might be on title, but you're in first position. So if they ever default, you have that property as collateral, right? Yeah. So those are a few examples. There's some people that get into tax liens, which tax liens you go buy someone that's past due on their property taxes, and they eventually have to pay that or lose the property. They lose the property, you get the property. They pay it, you're collecting by paying up front on what that property tax is. So. Yeah.
So I have one more question before we wrap this one up. So as someone inherits money, does that come into their life as just like income, or how is that taxed?
It depends on. So there's a thing called a step up in basis for capital gains. Let's say that someone paid $100,000 for an asset, a stock, a piece of real estate, or business. At the time of their death, it's now worth $1 million.
Yep.
Okay. So right there, that's a $900,000 capital gain.
Yeah.
But under the law, when you die, there's a thing called step up in basis. So they treat it like you paid $1 million. So there's no tax on that because it was capital gains.
Okay.
Now, what if it was a 401k? Well, if it can go 100% tax-free to the spouse, 100% tax-free, okay? But if it goes to someone other than the spouse, you have two options. One is you pay the tax. So that tax would have to be paid.
Yeah.
Or two, there's something called a stretch IRA. So the stretch IRA would make it that you take it over time instead of paying tax in that given year. So it kind of slows down the tax. I don't love that because you're still not getting full access to the money. It's kind of tied up inside of a government plan, and taxes are fluctuating as time goes on. So it depends on how the asset is structured. If it's life insurance would be 100% tax-free. But where all of these things would have a potential issue is the estate tax. Now you have to, be at a decent amount of wealth to hit the estate tax. During my lifetime, I think the lowest it was like $675,000. So things over $675,000 got hit. Now it's over 10 million. So it's fluctuated all over the place. Wow. So an estate tax could still apply even if there was no income tax. So you've got potential estate taxes, and you've got potential income taxes depending on it. But I think you just learned about the step up in basis if it was a capital gain asset.
Okay. I really think that's some good information.
We gave a few investment options. I mean, it really comes down to what your expertise is, what you're willing to learn about, what you're willing to spend time in. And, there's unfortunately, to create cash in a passive manner, yes, there's real estate investment trusts, and there's, real estate syndications and private placements, but a lot of those have a lot of risk, and you got to be really mindful of where that goes. We covered a few other options, including some outside the box ones like an intra-family loan or becoming, bridge loans and things like that for investors. But once again, a lot of these have risks. You've got to really know what you're doing. So ask your questions, askthemoneynerds.com. This is Garrett Gunderson. It's time to turn your thoughts into profits and build the life you love.